Welcome everyone. Thank you so much for joining me. If you haven't already, please consider subscribing now and make sure that you ring the bell to turn on video notifications. Taxes can feel overwhelming, it's true, but understanding deductions is one of the smartest ways to keep more of your hard-earned money. There are several key tax deductions that can help you lower your taxable income and possibly even reduce your overall tax bill. Whether you are a homeowner, a parent, or just someone trying to plan smarter for retirement, these are top 6 deductions worth knowing. Before we dive into them, it is important to remember the difference between a tax deduction and a tax credit. A tax deduction reduces the amount of income that you're taxed on, so it lowers your taxable income, in other words, but a tax credit actually directly reduces the amount of tax that you owe. For the 2025 tax year, the standard deduction is $15,750 for single filers and $34,700 for married couples filing jointly. You should only itemize if your eligible deductions exceed these amounts. Now, let's get into the top 6 tax deductions for 2025 and how each one could help you lower your taxable income. Mortgage interest deduction is the first one. If you own a home and if you itemize your deductions, you can usually deduct the interest that you pay on your mortgage. For home purchases before December 15th, 2017, you can deduct interest on up to $1 million in mortgage debt. For homes bought after that date, the deduction applies to interest on up to $750,000 of acquisition debt. This applies to both your primary and your second homes, and you must actually be the one responsible for the debt and making payments. Your lender reports this information to the IRS, so it is essential that your records do match. If you refinanced your home and it was originally purchased before December the 15th, 2017, you can still deduct the full amount as long as the new loan doesn't exceed the original mortgage balance. The next tax deduction that I will tell you about in this video is state and local taxes, or SALT deduction. This deduction is one of the most debated and widely used among homeowners and higher income taxpayers. For 2025, tax deduction limits have significantly increased to $40,000 per year. The cap continues to rise by 1% every single year through 2029 before returning to $10,000 in 2030. But there is a catch. For taxpayers earning over $500,000, the deduction phases back down to $10,000. So depending on your income level and where you live, especially in states with high income and property taxes, this deduction can make a noticeable difference in your tax bill. Charitable donations. Giving back not only feels good, but can also lower your taxes. If you itemize, you can deduct both cash and non-cash donations to qualified nonprofit organizations. Just make sure that you keep your proper documentation, keep your receipts. For any donation under $250, a bank record or a receipt actually will work just fine. For donations above $250, you will need an acknowledgement letter from the organization that received your donation. And if you're donating property that is worth more than $500, you will need to file an additional Form 8283 with your return. Starting in 2026, even people who don't itemize will get a small break. Single filers can deduct up to $1,000 and married couples up to $2,000 in direct cash gifts to eligible 501c3 charities. Medical expenses and health savings accounts, HSA. Healthcare costs can be very steep, but the tax code offers some relief. If you itemize, you can deduct medical and dental expenses that exceed 7.5% of your adjusted gross income. For example, if your AGI is, let's say, $100,000, only expenses above $7,500 can be deductible. This can include insurance premiums, out-of-pocket expenses, and care for your dependents. On top of that, if you have a health savings account, HSA, which you can only open if you have a high deductible health plan, of course, you can deduct your contributions. For 2025, the contribution limit is $4,300 for individuals and $8,550 for families, with an additional $1,000 allowed if you are 55 or older. The best part about it is that HSA contributions, growth, and withdrawals for qualified medical expenses are all tax-free. 401k and IRA contributions. Saving for retirement can also save you money on taxes. Contributions to a traditional 401k are tax deductible, which will reduce your taxable income for the entire year. For 2025, you can contribute up to $23,500, and if you're 50 or older, you can qualify for a catch-up contribution. Under Secure 2.0 Act, people aged 60 to 63 get an even higher catch-up limit, $11,250 for 2025. Now, I just uploaded an entire video where I discuss the changes for 2026 with respect to retirement accounts. Definitely watch that video next if you haven't already. There is a major change that you must know about if you have a 401k or a Roth 401k account. For IRAs specifically, the contribution limit is $7,000 with an extra $1,000 allowed if you're over 50. These deductions, however, phase out for higher earners who are also covered by a workplace retirement plan. The bottom line is this: every dollar that you contribute to your retirement account can reduce your taxable income. Now let's talk about student loan interest deductions. If you're still paying off your student loans, you can deduct up to $2,500 in interest every single year. The best part is that this is an above-the-line deduction, meaning that you don't need to itemize to claim it. It is available to most taxpayers who actually fall within certain income limits, and it can make a real difference too, especially early in your repayment years. So should you itemize or take the standard deduction? That really depends on your financial situation. If your eligible itemized deductions like mortgage interest, charitable giving, and medical expenses add up to more than your standard deduction, itemizing can lower your tax bill. If not, the standard deduction might make more sense. But even if you don't itemize, don't overlook above-the-line deductions like student loan interest or HSA contributions, which can still reduce your taxable income. And remember, tax credits are different from tax deductions. Credits such as the child tax credit, adoption credit, and earned income credit directly cut your tax bill dollar for dollar. And to learn more about tax credits, take a look at several videos that are available here on my channel to help you gain the most tax benefits possible. Stay tuned for new updates. I upload videos on a weekly basis, and I would love to have you back for more content. Remember to subscribe, enable notifications by ringing the bell, and I will see you back here soon. I hope you have a great day. Take care.